Go.
Streaming from South Africa to the world. This is the Stonks Go Moon podcast. What just happened? We break it down so you don't have to.
Welcome everyone to the Stonks Go Moon podcast. My guest today, the first returning guest, might I say, Simon Ree. He is the founder of the Tao of Trading, wizard, friend of the show. Simon, how are you?
Really well, Rocco. Thanks for having me back on.
It's only a pleasure. Simon, if you go onto Reddit or Discord or some of these sites, especially the people that start out trading, right? The first FOMC meeting is always like, you get people shouting, what is FOMC? Is it like FOMO? It's not really, it's not as memeable as, let's say, Diamond Hands or something like that. So I thought, let's start by giving people an introduction. And when I say us or me, I mean you. What is the FOMC and what exactly is its functionality?
Sure. So the FOMC is a division of the Federal Reserve Bank of the US, which is the United States Central Bank. So the Fed, as it's abbreviated, has historically had a dual mandate of price stability and maximum sustainable employment. So when it comes to price stability, they've got an explicit 2% inflation target. Maximum sustainable employment is obviously a bit of a moving target. But one of the tools they use to achieve those two outcomes is monetary policy. And monetary policy is what is handled by the FOMC, the Federal Open Markets Committee. So it's one of the divisions of the Fed, and it's the division that facilitates monetary policy. So they set short-term interest rates. They set the price of money that banks can access funds at and that banks can lend money to each other at. And they do other things as well. You know, they're responsible for, steering the US payment system and fostering safety of payments, settlement system, and that sort of thing. But when we talk about FOMC meetings, it's all about how they're going to implement monetary policy, and particularly of interest is any changes to monetary policy in the future.
So thank you. I think that explains it very well, especially now, because I think the first question comes after the FOMC meeting, because you get this reaction post the meeting.
Yeah.
And then maybe novice traders had a position, it changed violently, and now they're sort of scurrying about and saying, okay, well, what happened? And with this last meeting, there was a big knee-jerk reaction, especially in the gold market. Gold hasn't come back to previous levels. Indices recovered well. Would you care to unpack that meeting for us a little bit?
Yeah, I'd love to. So what happened on Wednesday last week, 16th of June, Jerome Powell, who's chairman of the Fed, he sent the market what was perceived as a bit of a hawkish surprise. I mean, it wasn't a huge deal really. But what happened was the Fed acknowledged inflation, which they kind of hadn't the previous two meetings, even though inflationary pressures had been building. So what happened in the markets, if you dial back to sort of August or September, tech started to lag. Tech has been leading the market, since 2008 till 2009. It started to lag sort of third quarter of last year and end of the third quarter. And what really took off were so-called reflation plays, industrials, banks, commodities, ags, those types of things. Things that are perceived, either companies that are expected to do well in a reflationary environment, or things like commodities that are expected to act as a hedge against inflation.
Quickly, for
So,
those that are not familiar with the term reflation, what would that be in layman's terms?
So reflation is economic policy. It's both fiscal and monetary policy that is aimed essentially at avoiding deflation. So if you look at what's happened since the global financial crisis in 08-09, we have had persistently low inflation in the US and most developed economies, and the constant specter of deflation. And so a reflationary policy, it's government spending, it's deficit spending, it's free money, ZIRP, zero interest rate policy,
Helicopter
all
money.
things that are aimed at, but it's policy that's aimed at either increasing economic activity and disincentivizing saving. They want people to spend money. You look at the US economy, 70% of GDP approximately is consumption, and if people are just hoarding money, it doesn't do the economy any favors at all. Okay. So the Fed's been walking a bit of a tightrope with regard to bond yields. Okay, you're aware that the Fed is currently purchasing $120 billion worth of assets a month, and the Fed needs to keep bond yields low. All right, they need bond yields low so that the US Treasury and everyone else, all right, can fund their debt load.
Yeah.
Let interest rates get too high, and all of a sudden, people start calling into question the solvency of all sorts of entities that are carrying high debt loads. But the Fed can't afford to have bond yields fall too low, because then people get scared of deflation again, and they don't believe the reflation story. They don't believe these reflationary policies of fiscal and monetary policy are working. So with the Fed acknowledging inflation and acknowledging, I guess, economic recovery, a couple of things happened. First of all, you've got every man and his dog and his mother-in-law piled into the reflation trade in the last 6 months. And if you cast your mind back to May, this is when all of the so-called experts were screaming from the rooftops, hyperinflation is coming, you've got to buy gold, you've got to buy ags, you've got to buy reflation stocks.
Yes.
And when everybody is screaming that from the rooftops, you know that the trade is coming perilously close to the end. And that's exactly what happened. So it's a classic case of buy the rumor, sell the news.
Yes.
The Fed acknowledged inflation, and all of a sudden the inflation trade kind of stops, or people sell the news, that they take profit on it. The other thing that happened is bonds rallied, okay, which means bond yields fell. Now, bond yield, think about the 10-year bond yield. It's a function of how people perceive future economic growth and or real inflation rates. So if bond yields fall, that means the market is pricing in lower bond yields, lower inflation and or lower economic growth. Why would they be doing that when the Fed is kind of keying people up for higher rates? So what the Fed did was they said, previously the market had been expecting one rate rise in 2024.
Yes.
Powell said, we think we're going to raise twice in 2023. So he's brought forward the perspective of rate rises, and he's also perhaps increased the frequency of them. Now, rate rises are bad for inflation, okay, and generally considered to be bad for economic growth. So the bond market started pricing that in. Now, part of the reason why back in September we saw a big switch out of tech, right? High beta tech stocks got dumped, and even stocks like Apple and Amazon became laggards. What happens is, cast your mind back to 2009, the economic recovery has been very lackluster. The US economy has been growing at kind of 2%, 2 point something percent for the last decade, which is well below trend. So in that sort of an environment, you're not clamoring to own stocks whose earnings are a function of GDP growth. You think about railroads or a company like FedEx, for example, or stocks that really require increasing economic growth to increase their earnings. What you want to earn is stocks that can grow their earnings because they're in a secular growth industry. You think of Google, right? The explosion in search and online advertising. Same with Facebook, online advertising.
Very good tip.
They've been major beneficiaries. Look at Shopify, with the explosion in e-commerce. These are companies that have grown their earnings regardless of what the real economy is doing. But the share price performance of these companies has been so impressive that they started trading at what could be considered, expensive valuations. Yeah. So the market starts saying, well, if we're going to go through a period of stronger economic growth and higher inflation, why do I need to own these really expensive tech companies when I can buy a really cheap bank or a really cheap railroad? And that's why we saw the massive outperformance of cyclical companies and so-called value companies and banks as bond yields increased and the yield curve steepened.
That makes a lot of sense.
Now, with the Fed...
Essentially what you're saying to me is that the market participants need to believe or the narrative that the Fed pushes in order for, because it's like a belief system, if I can put it like that.
Oh, absolutely. I mean, 90% of what the Fed does is a confidence trick. Okay, quantitative easing. There is no mechanism via which the printed money from the Fed goes into the stock market. Okay, it's all about confidence.
If enough people believe
exactly
that narrative, then it happens.
And the correlation is undeniable, right? You look at the Fed balance sheet, and the correlation with the S&P 500. I mean, it's undeniable.
Yeah.
Despite a transmission mechanism.
So,
or a lack of transition mechanism.
In your previous appearance on the show, you mentioned the T word, of course, tapering, and I think that's become sort of a fear of many markets, people that speculate, analysts. And in that meeting, Paul he didn't use the T word, right?
No, that's right.
So, and we had a bit of a knee-jerk reaction. So, with that in mind, has your market view changed at all? And if so, why? And also vice versa, if not, then why?
My market view hasn't really changed. I still think that the market is set up to make higher highs. I think we're still in a buy the dip sort of an environment. And I think until the Fed tells us they're not buying $120 billion worth of bonds every month, dips should be bought. Now, when the Fed does come out and say something along those lines, because that is a real withdrawal of liquidity, that is when we need to be very, very careful. But until and unless that happens, I think we're in a buy the dip environment.
The one thing that is at the back of my mind is if that happens and there is a lot of leverage in the market's over leveraged, that reaction could possibly be very violent.
It could be incredibly swift. Yeah.
Would you say if I can put you on the spot, what is the time horizon that we are looking at here, given maybe in quarters?
I would think, well, you mean in terms of a change in policy and a potential peak in the market?
Yes.
I would think 3 to 4 quarters at the outside.
Well, guys, there you have it. 3 to 4 quarters, ears to the ground.
And it could happen sooner. I mean, if the economy continues to rip higher and inflation concerns become re-agitated, it could happen sooner than that.
Simon, I want to thank you so much for coming on the show. If people want to connect with you, where can they do so? And also, what else are you busy with?
So connect with me on LinkedIn. More than happy to share my thoughts on LinkedIn, which my thoughts aren't always popular, but I share them anyway. My website, taooftrading.com. That's TAOOFTRADING.com. You can join my mailing list, get a free ebook, and follow what I'm doing there as well. I trade for a living, and I teach people how to trade. Similar to what you do, I guess, Rocco.
Thank you so much, Simon. You're doing something interesting with Mark Ross. You care to elaborate a bit about that?
So, yeah, Mark Ross and I have put our heads together, and we've started up a website called Absolute FinTech. We've both got a passion for finance. I'm sort of more on the finance trading side of things. Yes. Mark is more on the finance and technical and coding side of things.
Yes.
So we've got different yet complementary skill sets, and we're providing free masterclasses every Sunday at 9:30 a.m. New York time to help people who are interested in learning more about the markets, more about finance, more about how to get into the finance industry, how to succeed in the finance industry, those types of topics.
I think that's worth a shout out, and we'll put the link in the comments as well. Simon,
I think we should have you on as a guest speaker soon. Okay.
Definitely. To our listeners, peace, love, and prosperity. Catch you in the next one.